Hello, this is Heather Marchant from RP Capital. I wanted to go through a presentation that I have done about cost segregation because I get a lot of questions about this and I think it will be useful. So there we go. So first, just a brief overview. I'm not an accountant. I'm not giving tax advice. But everyone needs tax savings, right? Covering how this works, what bonus depreciation is, and how you can pay less taxes with this strategy. I'm going to share an example actually as the bulk of the presentation. It is my own rental property. So first, we all know, gosh, from the beginning of time in our country that taxes have been a problem, right? Fighting against overtaxation. So I'm of the mindset that paying my fair share is fine, but paying other people's fair share isn't my goal for sure. So we're going to cover normal depreciation. Some people look at this and barely understand what depreciation is. So I'm going to kind of cover the numbers and where it comes from. So this is the house that I bought for $79,900. You cannot depreciate land. It does not go down. It's not a consumable, right? So land doesn't get used up, whereas a house over time will need to just be replaced eventually, right? So it's 27 and a half years currently with straight line depreciation. So if I take that $79,900 home and I take 80% of it, that's that $66,086. You multiply it by 3.63%, and my deduction for this property is $2,399, so $2,400. Then I have a tax bracket, right? So that's just my write-off, but then I have my tax bracket at a 25% tax bracket. That's $600 in actual in your pocket savings on the end of your tax return, okay? So if you have 10 rental properties, depreciation is pretty attractive. I mean, that's almost $25,000 in a write-off that you get. And then at that 25% tax bracket, that's $6,000 you can save every year and for 27 and a half years. So cost segregation is a little bit different. So it's basically saying there are some parts in a home that aren't going to last 27 and a half years. If you look around your home, you'll see that there are things that you know aren't going to last that long, right? So I have a faucet that I put in when I first bought my home 6 years ago, and I've already replaced that brand new faucet with another brand new faucet. So kind of a way of looking at it, right? So you'll see the 5 or 7 years are carpeting. In that blue graph here, you'll see lighting, millwork, plumbing, electrical, the land improvements, your landscaping, your sidewalks, parking lots, etc. And then the real property is the stuff that's going to last a long time, okay? Your foundation, your walls, your roof, hardware. So those are your 27 and a half year depreciables in a single family home in our example. So you'll see that a good portion of the property can be segregated out to be depreciated over a faster timeline. So if you're breaking out that $66,000 on that previous slide, and you can break it out over a shorter period of time versus dividing it over 27 and a half years, that's obviously a bigger savings that you can write off every year. Okay, so we're going to take this example and we're going to run it through with cost segregation, because cost segregation has been around for a little while, but it hasn't been financially achievable because the study to break out these costs has historically been pretty expensive. So if you're not going to save a ton of money on it and you're going to spend several $1,000s to get a study to break out these costs, it's just not worth it. So typically this has been done on apartment buildings or commercial properties. So here's our example. This is my cute house, the $79,900 house. It's in North Carolina. Love this house. Is my first rental property. So this is the pro forma, what I paid for it. It doesn't include closing costs on here, but my down payment there is about $16,000, that second number under the purchase price. So we're going to come back to this example several times throughout these slides, okay? So I will bring back these numbers in front of you. However, you'll see here that this is the depreciation. So that 3.63%, my tax deduction in my savings on my taxes, $580. So now we are going to run through and say, okay, I want to do a cost segregation on this property. So I sent over to a cost segregation professional. I sent him the pro forma and the year I bought it and my current depreciation schedule, because I purchased this property several years ago. I needed to get the current depreciation schedule from my tax return. So it was actually pretty easy to find. I located it and I sent it over to this cost segregation professional, and he sent me back this estimate of benefits. So he said, look, if I do this for you, this is an estimated tax savings there on that gold bar of what we think you can have an additional depreciation deductions. And I said, no brainer, because he charges full price $850 for this study. We have a negotiated rate as our company, our clients get the negotiated rate. So that it was even less expensive than the $850. So I said, all day long, I'm gonna go ahead and spend that money. So then he sent me over the study and he said, okay, here I'm going to break out all of the costs. So you'll see there on the right is the main breakdown of the costs. So you see the total is still that 66,086. That is 80% of what I paid for the property. So if it's a property that you know how much you paid for the land, say you bought the land and built a house on it, then that may differ, right? You may have not just the 80-20% breakdown, but in this case, I just did the breakdown of 80% versus 20% value for the land. So you'll see the foundation costs there, the framing, exterior walls, the roof, all of those finishes and things, what they cost, okay? So then he says that my additional depreciation deductions are $7,877. So the bonus depreciation, this is where it gets exciting because you can get those costs segregated out. You can depreciate them over a shorter period of time, which is awesome. But in the last tax law change, that Tax Cuts and Jobs Act of 2018 made this even better. So before, you would break that out over the shorter period of time for those 7 or 10, 5, 7 or 15 years, you'd get a little bit a bump in your depreciation. You'd still depreciate the structure, your framing, your roof, those 27.5-year items from that pie chart. You would still depreciate those over 27.5 years. So you're basically just breaking it out over different depreciation schedules. Well, under the last tax law change, they made it so that you can write it off in the first year that the property is placed in service. So anything that's not the 27.5 year, you can write off in the first year that you own the property, which may sound, oh, that's intriguing, Heather, but bear with me here. We're going to keep going through the example. A house that I paid out of my own pocket in down payment, $16,000, what it looked like on the actual depreciation on my tax return, I'm going to show you. So here's the bonus depreciation and how it breaks out. So you'll see there in blue, the life, that third column over, the 5, 7, and 15 years. This is not an office building, so there's no office furniture, fixtures, or equipment. So that is 0 on that line. But you'll see there the $14,000 and the almost $13,000 there. Those are the two items that I can break out over that faster schedule. But you'll still see at the top that $38,000 number is still the 27.5-year depreciation. So I'm still going to take, still about 50% of the property, I'm still going to be depreciating over that longer schedule every year. So those two combined are $27,354. So then I'm going to show you my actual tax return from 2018. So I took that 5-year and 15-year. All I did literally was send that piece of paper to my accountant, and he did this. I didn't have to do any of the work, but I also hire an accountant that understands this. So keep that in mind. You'll see up here, the building still has the 27.5-year depreciation that I will take over the next several, 20 plus years. However, the 5 and 15-year depreciation, I can write off in year 1, which was in 2018 tax year that I did this, because I went back in time to do this. So here is another page of my tax return showing this is when I take my tax bracket into account. Remember how we had to take it by the 25%? So the personal property write-off there is $5,865. So my total depreciation there is over $7,000. So a couple things you need to know about this. So you close on a property, as long as it's by the end of the tax year, you can take the full depreciation and bonus depreciation for the entire year. So December is our busiest month as a company. Well, I should say November, but then December, our closings are insane. Everyone waits too long, and then it's a little bit stressful. But because if you don't hit December 31st and you hit January 2nd, then you don't get the depreciation for that tax year. It comes on the following year when you purchase the property. The cost segregation study literally took me about 48 hours to get back. If he's busy, if he's getting a lot of them at the same time, or if people are waiting until the last minute on their getting these done for their taxes, then it obviously could take a little bit longer, maybe a couple weeks. It is less expensive if you don't have to do what's called a look back study. So mine, I had to go back and amend my depreciation schedule. I had to change it because I had already filed taxes after I purchased this property. So it was a little bit more expensive. It's $50 more expensive for our clients. It's not a huge number, but if you can be forward thinking on it and do it in the right tax year, then it's obviously going to save you some money. So if you sell the property and you don't own it for that full 5 or 15 years, you may have to pay back the taxes unless you do a 1031 exchange. So keep that in mind. You can't own a property for 2 years and depreciate it over 27 and a half or over 15, right? So keep that in mind. Filing taxes as a real estate professional allows you to have no limit on the amount of depreciation. This is kind of a big deal. Most taxpayers are capped at $25,000 of this depreciation that they can take on their taxes per tax year. However, if you make too much money if it's over $150,000 a year, that goes down to zero. You can write it off against investment income and passive income. So there may be some other ways to strategically use it. It does carry forward, is what my accountant tells me as well. So you can carry the loss forward, but there is a cap. So filing taxes as a real estate professional really helps. Granted, I do real estate for a living, right? So that's no problem. I'm an active real estate professional where you can file as a passive real estate professional where you're just managing your own real estate portfolio. You do not need to have a real estate license or anything like that. Right now, there are only 2 requirements. And it has to be your main source of time spent. You can't work full-time and tell the IRS you're a full-time real estate investor. They'll say that's impossible. So keep that in mind. And then you also have to spend 750 hours during the course of a year on your real estate business. So a lot of my clients are working toward their spouse filing their taxes as a real estate professional in order to help with this. But if you work part-time, it usually can still work. I would ask your accountant the best strategy to help you be able to file as a real estate professional. I have some clients whose spouse works on paper, works for the business if they own their own business. And so they'll reduce their payroll or some other strategies they've just gotten with their accountants to understand the best way for them to be able to still keep money coming in, of course, but file as the real estate professional. If you're looking at, the tax savings over time and the write-off potential, it may even be worth a spouse quitting their job to file as a real estate professional. So keep all those things in mind. So back to this property, I wanted to go through the actual investment. So my closing costs on this property were about $6,000 from what I recall. They were a little bit higher due to the loan size and things like that. So I didn't put that in here, but that's easy to obviously calculate. So my cash flow has increased. They have raised my rents several times now, which has been awesome. It started out with the rent at $750. It's now at $900. So I've run the numbers on selling this property with my return on equity several times, and it still makes sense to keep it at this point. So even though it's killing it. So my cash on cash return has just skyrocketed because of that. None of my expenses have changed. This property management company, it's basically a flat rate until the tenant pays more than $1,000 a month in rent. And so I have had no change in expenses. And I've actually not put a penny of my own money into maintenance either, not $1. So pretty cool. Pretty lucky, I should say. Tax reduction. So this is just the 27 and a half year depreciation. It was higher than pro forma. principal reduction. That's the tenant paying down the mortgage every month. It's not super attractive, but hey, that's better than you can get in a savings account right now. 6% rate of return on just the tenant paying down the mortgage on this property. And then appreciation, it's actually appreciated well over this $4,000 estimate. It's a 25% rate of return though, because I only paid about $16,000 in down payment on this property. It's not 25% appreciation. It's a rate of return on my appreciation. And so my total for just 1 year in owning this property, if I'm looking at these numbers annually, is $10,000 or 68%. However, with my bonus depreciation, I've essentially made all my money back without the down payment, of course, but some of that down payment is prepaid taxes and insurance and things. So it's not a just easy number to analyze that way. But still, even if it was in there, it's still a fantastic rate of return. So this bonus depreciation just gives you a leg up, allows you to be able to purchase more properties at a faster rate, and allows you to just help to defray your tax risk. A lot of our clients are really high income earners, so having another write-off is super helpful. So this is an excellent tool. It may not work for everyone, but with the way I look at it, if you don't even know this exists, you have nothing to strategize for, to work for. If you're wanting to retire and figure out how, or to retire a spouse, this gives you kind of a benchmark or something to work for. That being said, this is tax law. This could change. So it's what we have right now. It's a gift right now for us. So if you have any questions, you're welcome to reach out. You can reach out and invest@rpcinvest.com. You're welcome to reach out to me. It's heather@rpcinvest.com. I'm happy to answer any questions to the best of my ability. But of course, your accountant is going to be the best person to talk to about this, because they can help you with your specific tax situation. This is my specific tax situation, which isn't the same for everyone, of course. So if you have any questions, let me know. I look forward to help and answer. You guys have a good day.